I think at least a good chunk of that is related to AI. We also just have a demographic shift in the US. We have an aging population. One person can do the work of five people in a similar way that one person on a manufacturing line overseeing five robots building things and fixing occasional edge cases is different than just a line of people just manually doing things. I think that there's a massive repricing of them, which is not over yet. Nobody wants to buy a falling knife. No one should buy a falling knife. It's less likely we see multi-trillion-dollar accumulation of value in AI companies. And it's actually, in some ways, I think it accrues more toward the users and the businesses. I think that basically there's more pressures against the deficit going down rather than a near-term explosion of the deficit. I just think it's gonna keep grinding higher. If you're holding Bitcoin, then apart from security fees, you're not really getting diluted at all over time. If you include near-term dilution, it's less than gold. If you're holding, say, treasuries, you may be getting 3% net dilution.
Welcoming back Lyn Alden to the show. I'm Nick Bhatia, the Bitcoin Layer. Lyn, welcome back.
Thanks for having me back. Always happy to be here.
Congrats on your second book. It's a science fiction book, The Stolgard Incident. Your first book, Broken Money, a game changer for a lot of people, really taking one of the greatest zoom out views on what money has been, is today, and could be in the future. The breakthrough for many people is that connection between money moving through space and time and how technology changed that. So you're a technology person. You've written a science fiction book. Let's start with your view. The next 5 years of technology, revolutions in AI, robotic revolutions possibly coming any day now. What do you think the world is headed for in the next 5 years of technology?
Great question. I mean, I think obviously the biggest and fastest impact is everything AI related. And I mean, that can mean a lot of different things to a lot of different people. There's multiple facets of AI. First, we got these super chatbots, and now we're moving more into agents. And that's also why we've seen, for example, first it was GPUs becoming so in demand, and then we have more RAM being so in demand because we want more working memory, more persistence. I think that trend is going to continue. I think it has a lot of legs to it. I don't think that AI is magic in some ways that some of the Super Bowls think. You know, they'll be like, okay, you'll see headlines from executives of some of these companies that are like in 18 months, like all jobs are like replaced by AI. I think a lot of that's talking their own book. I think also sometimes people get into kind of their own bubble. But the technology is powerful, no doubt. And so I think that right now what we're seeing in the U.S. economy and more broadly is you don't see a lot of firings from AI related reasons, but you kind of see a slowdown of hiring. And I think at least a good chunk of that is related to AI. We also just have a demographic shift in the US. We have an aging population. We also obviously had a very significant shift in net migration due to different border policies and things like that. So overall, there's just less new net job creation. But then we also add on that, you know, pretty much every company there has cost savings that they can find, especially on their back end, just routine tasks. So in a similar way that, say, automation and like offshoring was pretty disinflationary for kind of blue collar type of work, manufacturing work, it kind of it both suppressed wages and employment numbers, but also suppressed prices of those goods, which is good for all buyers throughout the say the 80s and 90s. I think this is similar for white collar work. A lot of things that are just kind of repetitive, that are historically pretty expensive to do. A pretty big chunk of that can now be automated, and you still have people overseeing it, but you know, one person can do the work of five people in a similar way that one person on a manufacturing line overseeing five robots building things and fixing occasional edge cases is different than just a line of people just manually doing things. And I think we'll see a similar thing in white collar work. Um, and so I think that's probably the biggest global impact. Now, when people talk about AI, they also talk about robots and drones. So the physical instantiation of AI. Everything is kind of exponentially harder once you bring in hardware into the equation and once you make things more portable. An example I like to point out is, I mean, Roomba's been around for decades and the company just went bankrupt. We still, I mean, to this day, robotic vacuums are not like clearly better than just human vacuums. I mean, there's obviously some cases it's convenient, other times it's like more trouble than it's worth. It's not been so obvious that it just catches on everywhere. So people are like, we're X years away from just humanoid robots everywhere doing everything. It's like the bellwethers. Let's get the vacuum working first. That's when we might be starting the flywheel here, right? So there's certain kind of just canaries in the coal mine you can watch. Another one I pointed out, a bellwether I watch is these robot dogs, right? Because it's the thing about robots is it's much easier to have things in a very controlled environment. When you have a manufacturing floor, it's a very controlled environment, and there are humans on standby to help with edge cases. Whenever you're doing something out in the field, whether it's driving, right? So we've always been 2 years away from full self-driving for a decade now. Even when it can work most of the time, it's because it kind of has to work all the time for it to be economically and kind of politically viable. Um, and same thing with like, okay, what is the last thing that a robot can do? Well, drive out to your house and come and fix your HVAC system, right? Deal with the family dog, interface with the customers, climb up. Every house is different, every system's different. Climb up, fix that, and then leave, right? So it's kind of like in the field operating versus in a clean environment. And so whenever you kind of make things portable or put it in the physical world, you introduce safety concerns. You have to you care about energy density all of a sudden, right? So the human brain, as powerful it is, and it's still as powerful as most supercomputers, runs on 20 watts roughly, which is insane. It's like a third of an incandescent light bulb. Whereas an equivalent amount of kind of processing power, the best way we estimate it, still takes megawatts, right? So we're off by something like an order of magnitude of a million or nearly a million. And so portable kind of thinking is a lot more challenging than data center thinking. And you can have situations where like a robot is not that smart, but it can call back to a data center. But then it relies on Wi-Fi or it relies on satellite communications, which means you can't necessarily put that in critical environments where it has to work or massive loss of life or property is at risk or lag is an issue. And so there are just kind of levels of steps here. And so going back to the robot dog, um, the difference between, say, a human robot and more of a kind of like a robot type of robot, like a dog type of robot, is a domestic dog is obviously a very complex, intelligent creature, and it relies on its human owner for edge cases. In a similar way, I think that household robots or corporate robots that, let's say you have a robot that secures the perimeter, it checks everything, it could eventually clean certain things. You can tell to do things. If a senior falls down and you say, okay, obviously call 911 is the easy one. We already have watches and things to do that, but it's like, okay, well, go get me my certain pills in this bathroom on this floor, and the device can go do that. It can help you with problems and just kind of carry out tasks for you. I think these kind of things we ramp up from here. I think we have to nail the robot vacuum. That's the bellwether. Then we kind of figure out, okay, what is a commercially viable robot dog where it becomes silly not to maybe have one? And then you go from there. And of course, I mean, robot dog can take different shapes. Technically, you can have a humanoid that kind of acts like a robot dog, but I think, it's a little bit easier form factor. So I think over 5 years, I think, obviously the white collar impact, just the non-robotic impact is, I think, sooner. And then we just kind of start watching a little bit of the robotic space as well. But I think that won't be super economically impactful within that 5-year period.
If you've been listening to the Bitcoin layer for a while, you already understand where we are headed. Conviction isn't the hard part anymore. Infrastructure is. How your Bitcoin is held, protected, how it moves, and how it transfers to the next generation. These are the questions that separate people who think they own Bitcoin from people who actually control it. The Bitcoin way handles this end to end, not as a custodian, but as your coach. Self-custody, cybersecurity, inheritance, node running, the full stack. Go to thebitcoinway.com/TBL and book a free call to learn how to step up your game. Now, this will dovetail with U.S. industrial policy, which we'll get to shortly. But I want to ask you a question that's going around. It's this concept: are software stocks completely unownable now? Is this dead money as an asset class? We see the reason people are asking this question is the performance. These stocks are down a lot, as and we see them going down on days where Anthropic releases a new feature, not even necessarily a new model, but just that Opus 4.6 can now do this. What do you think about this idea that software stocks are dead money?
I think that there's a massive repricing of them, which is not over yet. And so nobody wants to buy a falling knife. No one should buy a falling knife. So going into this, many of them were quite expensive. I mean, SaaS companies have very high margins generally, recurring revenue, which is very attractive to investors, pretty non-cyclical, kind of reliable revenue. So all these factors, investors say, I'll happily pay 30, 40, 50 times earnings for some of these is kind of how it's gone. And then suddenly, it's like, okay, well, if let's say design software or sales software, if we can have all these kind of AI models do things, could we have one employee do the work of five employees, and therefore we need to pay for one-fifth as many SaaS seats as we used to? Then suddenly that, the revenue models of those companies get challenged. It's maybe not that they're irrelevant products, but maybe we just need half or a quarter or a fifth of what we needed before. And then you could say, well, maybe those companies, maybe that'll be true, but then maybe those companies will increase the price per seat because each seat is more valuable. But then with these AI models, you can code up competitors, which kind of puts pressure on pricing. So if Adobe comes out and says, well, our software can do let's one designer do the work of five designers now, because, for example, Adobe and other SaaS companies have already integrated AI in many cases, and it is being used, and the company generates revenue from it. They can say, well, we can charge way more per seat now. A company can say, well, if you charge too much, I'll just have Claude just code me up a competitor that's 90% as good, and so if you just overcharge me, I'll just kind of go around that. Um, and so I think it's not that these things become irrelevant, at least not in probably an investable time horizon. I just think there's a massive repricing of revenue, and therefore valuations. If something grows slower and it's more uncertain, instead of putting a 30 times earnings multiple on it, maybe you put a 10 or 15 times multiple on it. Um, and we'll kind of see where the dust settles. I'm actually, from a kind of a value investing standpoint, I am watching the space for potential longs. I just There's no reason to be a hero and jump in while it's still going down. Um, it's kind of like, let it try to find a bottom. Let the market kind of tell you that maybe it's gotten super cheap. I think the numbers are already kind of cheap. And then if you kind of do a thesis and say, okay, how hard is this to recreate? How many users will they have in this new environment? Because most of these so far, it's not really impacting their numbers. It's impacting what people think will happen to the numbers 2, 3 years from now, not currently. So every quarter that comes out, all these new features, and meanwhile, Adobe's like, yep, record revenue, record earnings and free cash flow. And by the way, like their Firefly AI is like, yeah, that's the usage of that is up, 50% quarter over quarter, whatever the number is. So, but people are like, okay, when this gets good enough, and then the knowledge gets widespread enough how good this is, that they'll be under pressure, right? So I think there's going to be opportunities there, but I think it's natural that the price of these things came down because they were expensive, and they were kind of considered a sure thing. And now they're a less sure thing, and they should be cheaper until we kind of fully figure out how much of this can be replaced. The bull case for them partially is that I mean, I don't think we're going to be in a world where people just want to have custom software for everything, and have to maintain all their software indefinitely forever. I still think they're going to want certain service providers to give them a kind of quality product. Um, and even these companies, they benefit from AI because, let's say you're designing a SaaS product. Well, all your programmers, I mean, each one is now, managing AI agents writing the code. So you can do, a lot more with less. So they might obviously, they can have revenue challenges because of this, but they can cut expenses. So I think they become leaner, more efficient companies, that kind of help with just quality assurance. Like if Adobe is still cheap and still it's just quality, I still think there's a world for it. It just gets resized.
JP Morgan has their own white labeled OpenAI product. So every employee at JP Morgan, one of the largest financial employers on the planet, has access to an open AI model that allows them to achieve efficiencies, maybe hire less of outside vendors for these specific tasks, and make each individual employee more productive. So I wonder if you take that example and apply it out, how that impacts really your investment thesis here, both on the software stocks side and then just larger industrials, like how companies are going to use AI going forward and efficiencies, productivity gains even.
Yeah, I think there's going to be a lot of idiosyncrasies here. So, for example, with one of the early things people worried about was Google. People were like, well, who's Google searching anymore when they're just asking AI? So the view was Google searches are going to collapse. That's where they make most of the money. So be short Google. I years ago took the opposite side of that because they were fairly cheap. They had a fortress balance sheet, and my view was at least for like the next several years, it's not likely going to dig into Google's money searches. It's going to dig into their non-money searches. So for example, Google makes money when you search for plumber near me because every plumber near you wants to be on Google and will do ads and all sorts of stuff. Whereas if you just Google what is Napoleon Bonaparte's wife's name, you want to know it. So you can you can ask AI instead of Google. Google doesn't care because they don't make money from that search anyway. And so that's the majority of the types of searches that were being taken from Google and replaced by ChatGPT and now others. And so my view is okay, it's not as big of a near-term threat as people think. Two, Google was developing their own AI, which was less of a people were talking about it less a year or two ago, and now it's a bigger deal. And then also my view was that video content, basically because of Jevons paradox, basically as the cost of creating video content goes down, whether it's editing a podcast or whether it's creating an animation of some sort, even a realistic one. Google runs YouTube. They have the biggest like video platform along with TikTok, right? So more video content out there. So that can't be bad for them. So my view, I was long Google when it was cheap and kind of out of favor. That has now played out. I'm not really that once something kind of doubles, you're kind of the thesis is already kind of played out. I'm watching others to maybe do the same with, and my view is that there's gonna be a lot of things impacted. It's not fully clear what, but as things become cheap enough, if they have good balance sheets, and if they start finding evidence of a price bottom, you don't want to buy things when they're going straight down, but if they've gone down a lot, they get cheap, and then they start forming a little bit of a bottom. It becomes a potentially interesting 18 to 36 months kind of trade. And you can, if the thesis starts breaking down, you get out of the position. So I think there's going to be opportunities. There's things like insurance companies or banks that are kind of like regulated to exist in the front end, but there's a lot of expense they can trim on the back end with better AI, with better software, with just fewer employees able to do more work. So whether it's JP Morgan, whether it's a regional bank, whether it's an insurer, there's a lot of back end efficiencies that can be saved from this. So a lot of I think with let's say throughout the 2010s, the rise of these social media companies, the big winners were these mega cap social media companies. They had these big self-reinforcing network effects. They didn't need a ton of capex relative to their size. They got a ton of money. They surveilled all their users. They made a ton of money from this. A lot of the value accrued at the top of these companies, trillions and trillions of market cap created by this. I think AI is different because one, it's hardware based, right? So they have to redeploy a lot of their money back into the hardware, all that capex spending. And there's no real network effects, just kind of lower switching costs. If you're not the best model and another model's catching up, it's not that hard for a consumer or a business to switch over to someone who's doing better and offering a better product for less. So I think there's just less margins there. So I think it's less likely we see kind of just multi-trillion dollar accumulation of value in AI companies, and it's actually in some ways I think it accrues more toward the users and the businesses that are using these things. That basically a lot of things get cheaper and more efficient to produce, whether that's financial services, whether that's design services, whether that's editing services, whether that's translation services, whether it's administrative services. As kind of culture catches up, a lot of this is just way more efficient to do, and there will be winners and losers. Generally, I look for things where the front end's kind of locked in, and then there's a lot of things they can trim on the back end so they can kind of boost their margins.
Introducing TBL Pulse, our new incredible terminal packed with macro, liquidity, and Bitcoin data, actionable information to help your portfolios. Get full access to TBL Liquidity, our proprietary metric that helps you get a beat on risk markets with a high correlation with Bitcoin and the stock market. This is the terminal I use every day to understand where liquidity is and how the Bitcoin market is functioning. If you are already a TBL Pro subscriber, TBL Pulse is available to you right now. But for the first time, if you're not already a pro, TBL Pulse is now available as a standalone product. Go to thebitcoinlayer.com to find out more. What about the government, OpenAI, and Anthropic? Can you give us your quick take on the drama there in terms of Pentagon security?
Sure. Yeah, that played out a little while ago, which was Anthropic. Obviously governments around the world are already using and will continue to use AI. It was kind of revealed that they used AI for part of their Venezuela operation, which was very effective. And Anthropic basically said there are two things that's kind of our line in the sand. We don't think our product is suitable for, or that we're just not in favor of our product being used for. One is mass surveillance on American citizens, and two is automated kill decisions in military context. So sure, we can use AI to help you target, help you detect targets and all that, but yeah, we still want a human in the loop for basically pulling the trigger, either literally or metaphorically. Whereas the Pentagon wanted kind of just full authority to do whatever they want. So they canceled Anthropic's contracts and shifted over more toward. And it's a process. Obviously, these things don't just switch out overnight, but they switched over to OpenAI. And there were threats initially of going way further, which was, and to some extent it's kind of played out, which is you can say, okay, well, not only will we not use their products, we're not going to use any company that uses their products. So you can kind of make it really, you can kind of make them a black sheep, and you kind of push them out. And you can even do that for things that don't really direct. So you can say, well, okay, well, if we're going to keep using Microsoft, it means Microsoft can't use Anthropic, for example, for anything, even if it might not be a military context. Just the computers in some DoD area just can't have Anthropic now, even it has nothing to do with their two red lines, just because we don't like you anymore. And that can be challenging court, so it's still process. But it opens up. I mean, this goes back to science fiction, by the way. Science fiction it's been kind of known for a while. I mean, do you want AIs making like kill decisions? Because we already know there's hallucinations. You can ask basic answers. I mean, they'll be wrong and confidently wrong a lot of the time. And when those things make irreversible decisions, when humans make decisions, but then there's a chain of command you can potentially blame and hold accountable. If computers are making decisions, who do you blame when something goes wrong? And then, of course, there's like tail risk scenarios. You automate a lot of systems and they get hacked, and it makes a really big mistake. And then whose fault is that? So the part of what sci-fi does is it kind of thinks about what is possible, not necessarily what's going to happen, but what could happen, so that almost like warns you against it, so that you're already kind of thinking about it by the time it comes. Obviously, the extreme case is like the Terminator, Skynet case, but just like the fact that that exists in our cultural zeitgeist is actually useful, because every time we seize these risks, we think of Skynet, right? So it might be an extreme case, but people are like, do we really want to go to the Skynet path, right? It's like it kind of acts as like a little bit of a cultural checkpoint, I think, on some of these technologies.
Very interesting. Now, how are you using AI? You mentioned going from chat to agents. So I'm curious, and I'm sure people out there are curious. I'll just share on my side. I'm building a personal knowledge base, and some people call it personal OS, some people call it a second brain. But I'm trying to build something like that to get away from the chat aspect of AI and trying to use it myself. So people want to know, how are you using AI these days, Lyn?
Good question. I mean, for a while, the two early things I used it for, one was basically those early art concepts where, 3 years ago it would be horrible at it and it got better over time. So I would use it for like informal things, but then also even, for example, when designing this cover, for example, this is all human done, but when I'm communicating to the artist ideas, like what does this person look like? What does this eye look like? What is the background going to look like? I can communicate like ideas with an AI mockup, which then they can like make quality. They can make their own version. They can put the human inspiration on it. They can, do things like that. But it's effective for communicating ideas. So I've been pretty early in AI art generation, not necessarily for finished things, but just for really design. And then two, I mean, for like chatbots, I use it for obviously search. I use it for research. I use it for testing my ideas. I use it for editing to some extent, like proofreading in addition to human editors, just because AI is still not good enough for something like that. But at least it gives like a first pass for a lot of things. And so that those have been like the bulk of like the multi-year case. More recently, as like vibe coding is an increasingly viable thing to do. Obviously, the joke I think is everything is like a dashboard. So everyone's kind of a lot of people's like kind of the hello world program for vibe coding is often like a dashboard, something that you monitor a lot of things, so you have you kind of code up a dashboard that kind of collects those things for you, right? So that's kind of the early test. I haven't gone way further than that personally. Instead, what I do is because at Ego Death Capital, for example, we invest in a lot of startups. I'm constantly monitoring how other companies are deploying AI, right? Because I'm in more of the research and writing business and talking business. So I use AI a lot, but companies that are in the coding business, they're using AI. They have to be even more in the forefront of especially the agentic parts. So I look for companies that are incorporating agentic capabilities into, say, their APIs and basically into their products, looking to see how they're making sure that all their employees are using AI so that, one engineer can do the work of five engineers and one overseer, like administrator, can do the work of five administrators, or one accountant can do the work of five accountants, for example, by just incorporating AI. So I still, one of my goals over the next 12 months is to get more increasingly into the agenta aspects. I've been quite busy, but that's one of my focuses.
At the Bitcoin layer, we just released TBL Pulse. It's We used, of course, Claude Code to help us do it. We're bringing people the data that we use on a daily basis to everyone, and so I'm actually designing it with my own morning routine in mind, so that I have one place for everything. And I think it's a natural progression here as we go from, I'm also a writer, but I want to make sure that people are understanding my quantitative framework also. And it's something that I can give them access to. It it is really quite powerful. That's a separate project. It was my first Claude Code project, was building up our terminal. And the second one is building this personal knowledge base, which is essentially you put what you have onto your computer into folders and let the agent start building out your brain within the computer, so that you don't have to keep feeding it information about yourself. It's actually accumulating a wiki that's backlinked throughout on your desktop, essentially. And so it's all very fascinating. Lyn, let's shift gears to macro. We have I have a question for you before we get to nothing stops this fiscal train in the United States, which is that the rest of the world also has the option to print their local currency to cover up deficits or to monetize the debt. What do you feel about money printing and fiscal deficits abroad? What are the countries you think about that are most likely to do large quantitative easing programs or try to fight fiscal deficits with some sort of monetization?
Well, on average, money supply grows quicker in developing countries. They generally will average double digits, but there's a very long tail there. I mean, there are ones that average triple digits or more, especially during crises. I mean, one of the examples I pay close attention to is Egypt, because I live part of each year there, and they've actually managed. I mean, going with data going back really since they got out of colonialism, really going back to the 50s and 60s, they've managed to avoid hyperinflation or any sort of triple digit inflation, which is kind of notable for a country at that level of development. But they have averaged double digit inflation throughout that period. And we look at the money supply growth, I mean, it'll be 20% typically a year. If we get higher, say during the kind of the post-COVID years. And that's like, that's a bellwether that I watch because I'm familiar with. But there's a lot of countries like that where they are increasing their money supply faster than the US, faster than Europe, faster than Japan, faster than China. And so that's where you'll generally see the fastest money supply growth. It's not just monetizing fiscal deficits, but it's basically backstopping all the bank lending that's happening. It's occasionally monetizing fiscal deficits and just constantly using the currency as a release valve for that. In developed countries, because most debt's denominated in their own currency, and because the economies tend to be larger, more diverse, and obviously wealthier, shocks tend to be relatively smaller. Usually, at least. I mean, unless when Russia invades Ukraine and European natural gas soars, or now we have this closure of the Strait of Hormuz. I mean, obviously, or COVID, crises happen. The economies are able to handle it better. But I think around the world, I mean, we're going to see resumption basically of, I've called it the gradual print. It's like slow debt monetization. So we've had really from 2022 through 2025, many central banks have been consolidating their balance sheets. We've seen it from the Fed, we've seen it from the ECB, we've seen it from the BOJ. Um, I think that's kind of bottoming out. We've already seen that bottom out from the Fed. I think we're going to see it bottom out from other major central banks, and go to gradual balance sheet increases, which it kind of is like growing their balance sheet in line with nominal GDP, um, and monetizing a fraction of the debt. But those things tend to multiply because as you monetize a fraction of the debt, you increase the monetary base, you increase the overall amount of cash in the commercial banking system, which means that when you maintain certain capital ratio requirements or reserve requirements, whatever the case may be by country, it means they can keep lending more without running into either liquidity constraints or capital constraints. Um, and so it kind of keeps both the public and private sector going. Now, the Strait of Hormuz, when you have energy crises or raw materials crises, depending on how long or severe that goes, that could pull forward some things. You can get more printing and more crises from certain countries. But putting that aside for a second, I think, yeah, we're re-entering a period of kind of gradual balance sheet increases, gradual money supply growth, which mean developed country upper single digit a year is typical, and for many developing countries it'll be double digit and already has been double digit a year.
Now, I want to ask you about global inflation and US inflation on the back of all this. But first, I want to drill down on the private money creation aspect of this. Let's focus in the United States. We have SLR reform, we have banking reforms that are targeting freeing up private sector balance sheets to
Yeah.
create money to lend into the system. The traditional lending apparatus has changed over the last several years with private credit, where the banks lend into private credit and the private credit are basically leveraging existing capital,
Yeah.
new money printed by the banks, and lending that out into the economy. So give us your US centric private sector lending outlook in terms of private, the transition between traditional and private credit, but then also banking reform and trying to get traditional deposits, traditional M2 up in the United States, and maybe where that fits into the Fed's balance sheet picture in terms of maybe them doing, engaging in the gradual print or being able to dial it back.
Good set of questions. Really, ever since the global financial crisis, bank lending slowed down for a period of time. Partially, it's because just risk appetites changed, and partially it's because new regulations came in that just kind of added more constraints on lending. So you had slower bank lending. That was offset by larger, on average, fiscal deficits, some of which were monetized. Kind of the two main ways for broad money creation really are fractional reserve bank lending. Basically, when banks have a higher, just they lend more relative to the amount of reserves they're keeping in place, or the government they spend money into the economy, and instead of extracting it all from taxes or debt issuance, they have the central bank monetize part of it. And or the hybrid, of course, is when a commercial bank will buy some government bonds on its fractional reserves, and so those are ways they can kind of increase the broad money supply. Um, and as you point out, I mean, because there's been tighter kind of bank regulations, and because it's just been more conservative lending since the global financial crisis, we have seen a rise in private credit. And it'll be called shadow banks. It'll be called non-deposit financial institutions more broadly. That can include private equity and certain other things. But the private credit component, the interesting thing is that On its surface, private credit, especially the term shadow banks, sounds bad. It sounds like dangerous. On surface, what they do is actually in some way safer than a bank because instead of lending out someone's like demand deposits into illiquid loans or taking a business's like payroll like checking account and lending it out into illiquid loans and sometimes saying, oops, we can't necessarily pay you back right now, like say Silicon Valley Bank. Um, these private credit funds are saying, okay, well, you're a high net worth investor or you're an institution, a pension or an insurance company or whatever the case may be. You've got long term capital you want something to do with. We're making loans to businesses or consumers at 10% a year, and so you can give money to us and we'll lend it out. By the way, unlike a bank account, there's no promise on liquidity, right? We will try to provide liquidity when requested, but we're making illiquid loans with this is savings. It's not like a demand deposit. It's not near-term savings. It's an investment. So we will try to make liquidity available upon request, but no guarantees. And so it's actually closer to full reserve banking in many ways. Now the downside is it's more opaque. It is less regulated. So on average, you're gonna get a riskier loan type in there, which is why banks aren't doing it. And then the way that banks participate is in that risk reduced way. So they say, okay, we're not going to make those types of loans, at least at scale. Uh, and we'll let those full reserve shadow banks do it. But while all those private credit funds are taking all that kind of private capital, they also go to the bank and say, hey, can we borrow at 7% for a quarter of our funds? And it's collateralized by all of our lending, and the bank says, sure, because the way that works is that allows a credit fund to say, let's say an average, they make 10% yielding loans. They could potentially earn 12% net returns because they're borrowing some of that money at, say, 7%, lending it out at 10%. They're making an additional spread. So, if you're investing well, then leverage can be, conservative leverage can boost it. Obviously, it can go bad when things are going wrong. And from the bank's perspective, like we see a lot of headlines around private credit not doing great at the moment. When private credit defaults occur, the by far the first in line are all those investors, all those high net worth investors, insurance companies, pensions, other institutions that put money in, and now they're at risk of losing some of it, or sometimes they want to withdraw and they can't just because it might still be solvent, but not everyone can withdraw at the same time. But let's say you have actual defaults occur at scale, they start getting impaired. But the bank is still protected because they're not, they weren't investing in the fund directly. They were lending to the fund, which puts them higher in the capital stack. And so they'd have to have the private credit fund would have to have pretty massive losses to get to the point where they can't pay back the bank loan. And then you look at things like, well, what percentage of all bank assets are in private credit? Broadly speaking, banks have lent 1.9 trillion in the U.S. to non-deposit financial institutions, which is it's a lot, but that's out of 25 trillion in total bank assets in the U.S. So it's 7 to 8% of total bank assets are lent to non-deposit financial institutions. Of that, not all of that is private credit, but something over a trillion of that will be categorized as private credit in various ways, which means that you'd have to have pretty massive losses to start ricocheting into the actual core banking system. And even then, the numbers they likely would receive, other than maybe some banks you haven't heard of that are just oddly exposed, but all the big players, they generally have pretty conservative exposures. So they might take a hit here and there, but it doesn't like render them insolvent. So we have this, you can kind of call like a three-tier banking system. It's obviously the central bank, that's the base ledger. I mean, you've read the book on layers. Basically, in this context, we have that base layer. We have a commercial banking system on top of that fractional reserves, it makes loans, and then we have this tertiary layer that banks can lend to that can then re-lend in a riskier way that kind of reduces risk to the second layer, the banks. Where things like SLR and other changes come into play is that as the government debt keeps growing, as we hit 29 trillion and add 2 trillion or so of public debt each year, someone has to buy all those treasuries. The foreign sector is not buying as big of a share as they used to. They're still their nominal amount is increasing, but they're not buying as big of a share as they used to, in large part because the debt is growing faster than total trade is. So there's just not that many cash flows to reinvest into those treasuries. which means more of it has to be bought domestically. Um, Unlevered balance sheets can only buy so much. So insurance companies can only buy so much, and pensions can only buy so much, and individuals can only buy so much. So leveraged balance sheets like banks can buy a lot more. But they have various constraints on, how much duration they can have on their balance sheet, for example, and those numbers are negotiable. So how much treasuries, for example, count against a bank's overall kind of risk-weighted capital requirements is a regulatory number that can be adjusted. And recently, the Fed basically reduced SLR requirements so that effectively it lets banks hold a little bit more treasuries without being penalized. Is one way to putting it. And so you can kind of say, okay, well, all this has to be bought. The Fed's going to buy some. Commercial banks are going to buy some. Non-bank entities like households, insurance companies, pensions, other pools of capital, they're going to buy some. And wherever you kind of get issues, you can toggle a few things. The central bank can buy a little more. That's why we've seen a shift from balance sheet reduction to balance sheet increases. But they can also say, well, how can we help the commercial banking system buy more without taking on too much duration risk so you don't look like Silicon Valley Bank? Well, around the margins, you can tweak the supplementary leverage ratio to let them absorb a little more, and kind of go from there.
Did you know that TBL liquidity indicator flagged this current bear market on January 14th? Make sure you guys are signed up for TBL Pulse in order to get information on when the next green dot and positive liquidity wave are in store for risk markets. Every morning, I open TBL Pulse to track the slope of the cycle, look at Johan's Bitcoin charts, and give myself an edge on all the macro information out there. Every single piece of macro, liquidity, and Bitcoin data that you could ever want, all in one place, available to you, updating all the time. I am genuinely in awe of what we have created here, and I can't wait for you guys to check it out. Go to thebitcoinlayer.com to find out more. And so that people know about the Reserve Management Purchase Program at the Fed, it is allowed to buy out to 3-year securities. So it's not just bills. They can absorb some debt, a lot of debt in the short end of the curve. And what Lyn was talking about in terms of private sector banks being able to absorb these treasuries in deficit spending, that type of balance sheet operation doesn't affect the Fed in the way that when they buy the bill, the TGA settles against the reserve, but then the government spends it back into the economy. The client of the bank that bought the bill gets the fiscal deficit spending, and they credit a deposit to their client, and the reserve balance goes back up for the bank. So essentially, the bank doesn't draw on their reserves to fund the treasury. They just pair off their client's new money, deficit spending, with a new treasury bill. That will allow a lot more treasury issuance to be absorbed by private sector banks. There's also the stablecoin angle, Lyn, of course, with these new monetary issuers being able to raise capital through the issuance of tokens and then use that money to buy T-bills. I want to ask you about inflation now. There's the example that keeps coming up of the 1940s. Now we are in a war, and so the parallels increase once again. The need for more fiscal deficit, defense specific spending. So nothing stops this fiscal train is your big tagline over the last few years. It doesn't appear to be stopping. We appear to be going from 40 trillion today in total debt up about 2 trillion a year, maybe 50 trillion in half a decade. The idea that interest payments themselves are taking up an enormous portion of the tax revenue presents a challenge. There are the ways out that everybody knows that we can inflate our way out of this, a combination of nominal GDP growth and some productivity as well. So let's get into it. What is your view on the path from 40 to 50 trillion and inflation over that time period in the United States?
Good question. And I mean, for context, I've been comparing the 2020s to 1940s since the beginning of the 2020s. And it's already been directionally similar, which is that we've had inflation much higher than yields. Anyone holding currency or bonds got absolutely killed compared to anyone holding equities, real estate, gold, Bitcoin, high quality private equity, any fine art, things like that, right? Basically, we've kind of partially recollateralized balance sheets by devaluing a lot of this, and there's not due to so in the 70s, a lot of the money creation was from bank lending. You had the baby boomer generation entering their home buying years, their peak credit formation years. So you had a very big generation borrowing a lot of money combined with material shortages of energy, and so you got inflation from that. What the 40s and the 2020s have in common is that it's more from monetized fiscal deficits rather than large scale bank lending. And these things operate on a lag. So most of our monetized fiscal deficits were in 2020 and 2021, at least the monetization part. But that takes time to spread through the system. So the 2020, giga stimulus didn't really start impacting until 2021. The 2021 giga stimulus was kind of impacting later. Then of course we got war in Europe, so that put a kind of temporary inflationary factors on energy and other kind of food materials. And but even since then, even after the Fed started getting more hawkish, even after we haven't really done separate stimulus in the U.S., there's the Inflation Reduction Act did some stimulus, not really the type of quick acting type, but a lot of that money supply that was created still kind of worked its way through prices. So even things like just the price of insurance going up, let alone the price of food and just other things. Eventually, housing kind of settled down because obviously we had a boom in like apartment renting, and then eventually that kind of stagnated, but then it caught up elsewhere. So it takes time for that to work its way through the system, and it's not even because there are supply shortages in some areas and not others. We can always make more software, but we can't necessarily make more gold or more waterfront property. So you're going to get disproportionate price increases in response to all that money creation. And what we have, let's say, putting the latest crisis aside, we've got a more gradual situation again, which is we have a top in the U.S. We have top heavy demographics. It's also true for large portions of the rest of the developed world. In older times, like aging demographics could be disinflationary because the average 70-year-old will consume less than a 40-year-old with children and kind of is upgrading their consumption. But when you have a larger portion of the population that's not currently working, but then we do have pretty robust entitlement systems. So in the US, I mean, obviously per capita healthcare costs extremely high, Social Security is happening. That money is getting out to seniors and being spent into the economy, whether it's restaurants, whether it's travel, whether it's and even other things like funding their grandkids' wedding and hiring all the services that go with that, or helping their kids buy their first home. That is capital that is not quite with the speed of a stimulus check, but that is capital that is getting into the broader economy. It's going into healthcare, and then all those healthcare workers are spending into the economy. It's going into defense, and all those defense workers are spending into the economy. So we're kind of gradually kind of stimulating in a way. Now, for a number of years, it wasn't being bought by the central bank. It was being bought by commercial banks. It's being bought by other balance sheets. Now we've kind of gone back to that hybrid approach. And so we are going back to broad money supply growth. And on so that kind of money creation side is inflationary, but then it's offset by productivity growth, right? So if you look at the long arc of time, I mean, in the U.S., money supply growth is average, say, 7% a year. If you have, say, 3% average productivity growth every year, then the net result is you're likely to end up something like 4% price increases. And those won't be evenly distributed because you don't get equally productive at, you get more productive at making plastic toys and TVs than you get at mining new gold, for example, right? So you get disproportionate disinflation in the things we get way more abundant in, and you have most of the price increase show up in the things we don't get much better at making. So going forward over the next, say, 5-10 years, I think we're gonna, again, putting crises aside because a lot of them are unpredictable. I mean, it's unclear how long the current one's going to last. Um, I think we're going to have ongoing large defense spending, ongoing large entitlement spending. It'll be monetized where needed or absorbed by the private sector where possible. And that'll keep spilling out into the economy, keep growing money supply. And it's going to be partially offset by productivity growth, right? So we talked about AI should keep a lid on a lot of white collar services, even though you have money supply growth. So where does it show up? I mean, depending on how scarce energy is over this kind of period of time, it can show up in energy inflation and therefore energy finds its way into all sorts of goods and services, transportation, all this. It can show up in things that we're just not making much more of. I mean, we're not, no matter how much money we create, we're not making more Bitcoin than the current protocol allows. You're very unlikely to rapidly increase gold by the typical rate that gold increases. There's a real cost of building houses. I mean, there's abundant land, but there's NIMBYism. There's many kind of just frictions against just rapid house creation, including just there's materials and labor involved. Obviously, some scarcer than others. Waterfront compared to just you know suburban kind of sprawl. Um, and so I think that over time we will continue to see inflation. It'll show up in what is scarce. Some things become temporarily scarce. Other things are more persistently scarce. And it'll be offset by the areas that are not scarce. So throughout the 80s and 90s and 2000s, that was kind of manufacturing and electronics and Moore's law. I think part of that will continue. And then more recently, it'll show up in just kind of white collar wages and white collar services staying relatively cheap despite the growth in money supply, because that's not the bottleneck. That's the productivity offset.
What about the example from the 1940s of the Fed pegging Treasury yields in the low single digits in order to essentially suppress the amount of interest payments that the United States has to make in the midst of large defense spending? We had the 1951 Fed Treasury Accord, which broke that and gave the Fed back monetary policy. So, how are you using that example to guide what you view might be some unorthodox or changing monetary policy, whether or not it has anything to do with Kevin Warsh or the next leader?
So I mean, the most recent example of yield curve control is Japan was doing it for a while. The Fed actually, in their minutes, they discussed doing it in 2020 during the crisis of COVID. They ended up not pulling that trigger, but it's an option that they have. I think in general we've seen just softer approaches of it, which is, as the Fed just kind of puts out liquidity fires when they happen. So one is the standing repo facilities and things like that. They increase the fungibility between base cash and treasuries and mortgage-backed securities. So it allows entities to hold more securities, knowing that they can get cash when needed. And so that kind of just it helps all else being equal. It keeps yields low because it just boosts liquidity where possible, or at least the perception of liquidity, and just allows balance sheets to hold more than they might otherwise would if they weren't sure they'd have access to cash when they need it. And we saw that the Fed was kind of slow to raise rates in the face of inflation. They were kind of perceiving it as transitory, so they actually let some of that devaluation happen before they got hawkish. I don't think a lot of that was fully intentional, but it just, these are types of things that happen during wartime finance. They're kind of slow to be hawkish, you could say. Even during the peak hawkishness, they were relatively modest relative to the amount of inflation that was happening. And so, on average, if you were holding cash and bonds over the past 5, 6 years, you got devalued relative to CPI and especially relative to money supply growth and other kind of high quality financial assets. Um, so kind of that 2020, 2021 stimulus, even though that wasn't for war, that was the closest thing we've seen to World War II, like wartime financing. Like, back then I was like comparing it to wartime financing. Now we have more literal wars, but I think I wouldn't compare it to World War II in magnitude anywhere yet. Because I mean, for example, World War II, when you look at the popularity of it, I mean, after Pearl Harbor, 90 some percent of Americans were in favor of World War II. I mean, it was an extremely culturally unified time. It was like all in, basically. The current, say, conflict in Iran, I mean, less than half of Americans support it from the outset, which is very low for a starting war. Um, the president has talked about a $1.5 trillion defense budget. Getting that through Congress is another story. I'm sure they can get certain increases through. It's very unpopular to be against defense spending in general. No one wants to be a weak nation when you have a large economy, but I think there's going to be speed bumps on that along the way. And so I think that basically there's more pressures against the deficit going down rather than we're going to get like a near term explosion of the deficit. I just think it's going to keep grinding higher. Occasional crises could spike it even more, but I think that just the base case is it keeps just grinding upward over time. I think interest expense is going to even if you're not just rising interest rates, because we're no longer rising interest rates, even just by not having a 40-year period of declining interest rates, if you just kind of chop around in a sideways range, that just means that interest expense in general is more of an issue than it used to be. And so I think that central banks, including the Fed, will use yield curve control as kind of a last resort. And that instead, they'll use these softer methods, occasional balance sheet increases in line with nominal GDP growth, standing facilities to just increase the fungibility between longer duration securities and cash, and just kind of go from there. And so the end result is there is intervention in the market. It's less explicit, but yields don't keep up with the money supply growth. They don't keep up with high quality other types of assets. And so currency and bonds still end up not being the place to be, other than as a near term trade. I mean, like right now, until you see, say, a light at the end of the tunnel of the Strait of Hormuz crisis, I think cash and short term treasuries are one of the better risk adjusted assets someone could be in for a multi-month period. But over kind of a multi-year, multi-decade period, I think that those things will continue to be devalued relative to higher quality scarce assets.
Does CPI even matter? Because you talk about how the inflation won't be evenly distributed. So should investors even care about CPI? Is that what will guide Fed policy, or should people just be thinking about which asset class to own as opposed to obsessing over CPI? Because in the end, you and I are not recording something to as economists to analyze if CPI is going to go up or not. What we really care about is helping people make the right investment decisions.
Yeah, I think the latter is what's important. CPI is a very crude measure, even in the best of times. It's a changing basket of goods and services that tries to be something like the weighted average of what a consumer would buy. Um, there has been kind of certain decisions that have kind of kept it maybe a little lower than a truer measure. For example, by instead of including house prices, you include owner's equivalent rent, which kind of incorporates the structurally declining interest rates that were happening until recent years, um, and substitutions and things like that. So CPI is just a very crude measure. Inflation is a spectrum, right? So there's things that are super scarce, Bitcoin, gold, waterfront property, fine art. Then you get into semi-scarce, normal houses, oil, very skilled labor, for example. And then you get into things that are super abundant, anything affected by Moore's law, anything that's automatable, anything that AI can do. Generally, agriculture products is kind of the middle to kind of low scarcity range, especially over the longer term. And as you create more money, it shows up more in the scarce things. And so I generally view the framework is you want to ask, to what extent are you being diluted? Right. So whatever asset are you in, are you being diluted in one way or another? By if so, by how much? If you're holding gold, and let's say you're not paying any security fees on it, you're just holding gold, you're not getting a yield, but you're not really paying much in the way of expense ratios, you're getting diluted by something like 1.5% per year, which is not super rapid. If you add a little bit of expense to it, you can round up to 2% a year. Maybe that you're getting diluted after security fees and stuff like that. If you're holding Bitcoin, then apart from security fees, you're not really getting diluted at all over the fully diluted kind of long arc of time. If you include near-term dilution, it's less than gold. If you're holding, say, treasuries, you say, okay, well, I'm getting depends on what duration you're holding, but you're getting a 4% yield. You're facing 7% money supply growth, so you may be getting 3% net dilution. During the 2010s, you were getting much faster dilution because you were getting like zero yield and you were getting 6 to 7% money supply growth. So that's something that varies pretty sharply over time, unlike gold or Bitcoin. And if you're in developing market currency, maybe you're getting a 10% yield, but the money supply is growing by 20%, so maybe you're getting 10% dilution. If you're holding a very high quality equity, you might be getting negative dilution. Maybe they're buying back their own shares and their shares are getting more scarce. But then the question you have to ask, are you getting diluted in terms of market like percentage? Right? So if you're holding IBM shares, your total percentage of all IBM shares might be doing fine because they're buying back their own shares, but your ownership of like say the cloud computing space or the overall kind of commercial computing space has diminished because you've been diluted by other mega cap companies that have kind of eaten IBM's lunch, for example. So you want to own scarce things that are not getting diluted by competitors and that are not rapidly diluting themselves is kind of I think a way to think of it more so than just am I keeping up a CPI. I think CPI is kind of this lower target. It's easy to give people a number. This is the number you want to keep up with. but that's kind of a low hurdle. And especially for investors, like if you look at, for example, like the price of beef is like soaring right now, right? The price of wheat is not really soaring to the extent that beef is. And so when you look at like what basket do a lot of people own, and obviously it'll vary. For some people it involves more flight than others. So the cost of air travel, the cost of comfortable air travel is, obviously going up quite a bit. The cost of high quality nutritious food is different than just like the CPI food basket. The cost of owning a single family home and owning with similar building materials and quality of many years ago. Those are the types of targets that people care about. And also just more broadly, do you want to own equities? Do you want to own private equity? Do you want to own fine art or gold? Or do you want to own cash and bonds? And it can vary a little bit based on local bubbles or temporary changes in policy. But yeah, to the most part, it matters for investors, not the CPI target, but what do you actually want to own?
Lyn Alden, thank you so much for joining us today, author of Broken Money, which is up there on the shelf, and her new book, The Stolgard Incident, which is not a finance book, not a money book, but a science fiction thriller that she wrote. Thank you, as always, for joining us, for sharing your insights. There's a lot to unpack here in today's episode. Tell people where they can find your work and your books.
LynAlden.com is the hub. People can check that out. And the books are available on Amazon or many other online retailers.
Great.
Thanks for having me.
Of course. Thanks, Lyn. I'm Nick Bhatia with the Bitcoin Layer. We'll catch you guys next time.